Welcome everybody to Safe Option Strategies presentation of adjusting the bull put spread. This class is a production of Safe Option Strategies and the content is protected by copyright. Any reproduction or redistribution of this or any Safe Option Strategies presentation is strictly prohibited by law. The information presented in this class is for education purposes only. Safe Option Strategies does not make any recommendation to buy or sell stocks or options. Trading stocks and options comes with risk and you are solely responsible for any losses you may incur as a result of trading. Okay, so let's talk about let's review the bull put spread. Whether it was live or whether you listened to the recorded copy of it, hopefully the last class you went through was the bull put spread, so we're just going to review it really quickly. The bull put spread is a credit spread, and that means we're taking money in when we open the trade. We sell to open the trade, we buy to close the trade. A lot of people talk about the bull put spread taking advantage of a stagnant trend, but I promise you, if you want to have a higher rate of success when you put on bull put spreads, you want to look for a bullish trend. At the very bare minimum, your most recent technical crossovers need to be to the bullish side, and there needs to be a pretty strong level of support at or above where you place the strike price of your short option. Wherever that support line is, you want that short put strike there or below, and preferably below. And there needs to be that strong level of support. To open the trade, we put the short put out of the money. Usually it's going to be in the current month of expiration, 3, 4, maybe as many as 5 weeks out, and below that level of support, it's the primary money-making option. The long put, one or more strike prices lower short put strike price and in the same month or week expiration. For it to be a bull spread versus a bull put calendar or some other type of spread, the options need to be in the same expiration date. Doesn't matter if they're weekly, monthly, whatever, they need to be the same expiration date. The long put is our secondary or our hedging option. That is there to protect us. If stock got put to us at the short put strike price, the long put is there to protect us from a worst case scenario. And it creates our worst case. Our worst case scenario is that we have a place where we could sell that stock if it got put to us and know that we've capped our maximum loss. If you just did short puts by themselves, you could be in for a really bad situation. If the stock price plummeted, stock got put to you at $50 a share where your strike price was, the stock is now trading at $20 a share, and you're upside down $30 in a trade. You don't want that to ever happen. So that's what that long put is there is to be our hedging option. Now, unlike a debit spread where the cost basis is simply equal to how much money we spent to open the trade, in a credit spread, and in the bull put spread specifically, our cost basis is the difference between the strike prices of the options that we choose minus whatever credit, whatever net credit we took in on the overall trade. So if we had a $5 spread, if we were using the 50 strike price short put, the 45 strike price long put, that's a $5 spread between our strike prices. If the credit we took in for that 50 strike price short put minus the debit, the money that we spent for the long put, resulted in $1.25 as far as our total net credit. It was $1.25. We're going to take that $5 spread. We're going to subtract that $1.25 from that $5 spread, and that leaves us with $3.75. And $3.75 is our cost basis. Whether we profit or whether we make money or lose money, we're going to base that on where we come in relative to that $3.75. Okay, so our cost basis is we take that net credit that we bring in on the options, we subtract that from the difference in our strike prices, and that's our cost basis. Our maximum reward, of course, is that net credit, and a good target return against that risk could be anywhere from 15 to 50%, but we're going to try as often as possible to target 20% or more. A really nice scenario in a bull put spread is if our maximum profit is 35, 40, 50% would be our maximum return, and we set a target exit for 20 or 22 or 23 and have that opportunity to get out without having to let it go all the way to the expiration of the option. So that's a good goal to shoot for. A good target time in the trade is, ideally we would like to be in that trade for less than 4 weeks, if at all possible. So that's where that's how we're trying to set up the trade. All right, now, if we get in this trade, if we set up a bull put spread, whatever the strike prices are, what we want to have happen is, at the very bare minimum, we want to maintain some stagnant move. That's the bare minimum. But our preference is that we see some bullish movement. We want these options to lose value as fast as possible. If you remember from the previous class, the faster these options lose value, the quicker we can make a profit. If we took in a $1.25 credit, and later on we can close the whole trade for only 75 cents, we've captured 50 cents credit on that trade. We've booked that 50 cents per share as profit now. So the sooner we can do that, the better. And if it goes all the way to expiration, that's fine, as long as the stock is still trading higher than the strike price of the short put at expiration. Now, I'm going to go over 3 different ways to adjust a bull put spread. I'm going to insert and weave in a 4th way to adjust the bull put spread. It's not really a different way to adjust it, but it's kind of a, well, I'll explain when I get to it. I want you to understand, as I go through these 3 different ways to adjust the bull put spread, that I'm going in the reverse order of what is the most preferable way to adjust it versus the least preferable way to adjust it. And I'll give explanation as to why that is the case. But there are several different ways a bull put spread can be adjusted if it starts to trend against us. So we get into that bull put spread, we're expecting the stagnant to bullish movement, and lo and behold, the trend changes on us. And either our short put, the strike price, or excuse me, the price of the stock moves below our short put strike price, which means now that short put is in the money, or we've got a technical crossover, possibly a break in the support level, and it looks as though our short put is going to go in the money. And we decide, based on the change in technical indicators, on possibly a break in the level of support, and based on, you know, whatever that's driving that, information is driving that, we're going to take all of that into consideration, and we're going to decide we need to adjust this trade. Now I want to back up and add one thing in here. The reason we preferably want the strike price of this short put to not just be at a level of support, but to be below that level of support, is if we had our strike price of our short put, in this example we have it here at the 80 strike price. Let's say we had some support around, we had reason to think there was pretty strong support at 82.75. If we've got the stock kind of trading up like this and then it breaks and comes down, maybe right here we get a technical crossover, but we still have some room between the technical crossover, the level of support, and our strike price. And this gives us an opportunity to see, are we going to get a crossover and then maybe a reversal because of that support? Or if our strike price of our short put is right up here at that support level, we might not even see these technical crossovers until there's a breakthrough the level of support. And the farther down this stock is trading, the more challenging it is to adjust it. The adjustment, the one that we're going to cover first, the adjustment is far easier if we get technical indicators and a breakthrough, a support level, prior to reaching the strike price of our short put. So that's why when we set up the trade, sometimes it's hard to find a credit that we like, sometimes it's hard to find the conditions that are most preferable, but we would like to have the strike price of that short put lower than that level of support. Okay? So here is the first. Now, again, this, in my opinion, this is the least preferable adjustment to make. But once we see that strike there, that stock moving down, and it appears that our options are going to trend in the money, or maybe they already have, we can roll both options out in time and down to lower strike prices, and probably to be able to do that and still get some credit in the trade or still maintain some credit in the trade, we're probably going to have to increase the spread between the strike prices. The reason this is not the most preferable adjustment is because we add not only time to the trade, but there's a good chance we're going to add more risk to the trade. If we started out with the 80, let me back up a little bit here. If we started out with the 80 and the 77.50 strike prices, see if we can get that to go back there. Okay, if we started out with the 80, I know that's not in the right place, but let's say hypothetically, this was the 77.50 strike that we started out with. If we're going to make this adjustment where we roll both of our options out and down to lower strike prices, that $2.50 spread may end up turning into a $5 spread. It may turn into a $7.50 spread. And that adds risk to our trade. Our risk in the trade when we start out is the difference between those strike prices minus the credit that we take in. If we have to increase the difference in those strike prices, we have increased our risk. And by going farther out in time, we are also adding time to the trade. We have to be in the trade longer to see it get profitable. So this is an adjustment that can be made, but it's not in most cases going to be the preferred adjustment to make. It's kind of your last resort adjustment, if you will. Okay, if we looked at this on a stock chart, this is kind of what it would look like. We get into a bull put spread because we feel like we've got a very easily defined level of support, and maybe we feel like our support is even up here somewhere, but we've got that definable level of support. We've got the stock moving in a bullish direction, and so we place our short put about a month out in time, maybe a little over a month, maybe 5 weeks in some cases. And why? And just a reminder from the previous class, we go out a short distance in time because we want the rapid time decay. We want these options to expire as soon as possible, out of the money and worthless. That's the most ideal situation for a bull put spread. So we place our long put there as our protective option, our secondary, our hedging option, and then after just a week and a half in the trade, for some reason we get the sudden reversal, it's suddenly going against us. We can roll both of those options out and down. If you're able to do this as one transaction, and different brokers are going to have different setups. If you're able to do it as one transaction, you do it as one transaction, but if you have to do 2 different transactions, you roll your long put first, and then you roll your short put. Okay? So first you roll your long put, then you roll your short put, if you have to do it in 2 separate transactions. Now, adjusting any trade at all, it's absolutely crucial, it's absolutely important that we keep track of our cost basis. And one of the trickiest things in adjusting credit spreads is, in fact, keeping track of your cost basis. So let's say we started out with the 80-75 bull put spread, and everything we do with cost basis is about money in, money out. Now, I want to ask an important question right here, and for those of you that are live, you're welcome to join in. If you're watching a recording of this, just answer the question to yourself. When we start to roll this trade, how important is it to look at the original credit we took in on the trade? How important is that original credit? Well, whatever the credit was, we've now come to the determination that we're going to roll the trade. We've made the decision. Technical indicators have changed. Circumstances have changed. There's specific news that may be driving it. We've made the decision now that we're going to adjust the trade. How important is that original credit that we took in? Okay, I'm getting answers that range from not important at all to very important. One person said crucial. So I'm getting some different answers. I'm going to tell you this. The number one rule when we are rolling a short option is that we always try and take in as much or more credit on the new option that we're opening what we're paying currently for the old option that we're closing. We try and take in, let me repeat it, we try to take in as much or more credit on the new short option we're opening as what we're spending right now to close the old option, regardless of the original credit we took in. While that same rule applies to rolling an entire credit spread, while the same rule applies to rolling an entire credit spread, the difference is this. Your number one goal should still be take in as much credit on the new spread as what you are paying to close the old spread. So the rule transfers from the short option to the whole spread, but whatever that credit was you took in originally is what will give you a little bit of wiggle room when you're doing this. What is really important when you're adjusting an entire spread, not just an entire credit spread, not just the short option part of it, what's really important is you maintain a credit overall. So let me, here's what I mean by that. I'm going to go through this twice. The first time I go through this, we're not going to talk about the original credit that we took in when we opened the spread. Okay? For right now, let's ignore whatever that credit was we took in originally. We know right now today, based on the price of these options, that it's going to cost us $225 to close it. So whatever we might have taken in originally, right now at this moment in time, it's going to cost us $2.25. We're going to pay $2.39. We're looking at worst case scenario. We might do a little bit better, we might do a little bit worse, but we're going to assume that the option that we have to buy to close is going to be at the ask price, and the option that we sell to close is going to be at the bid price. So we're going to look at those two prices right there, and we're going to make the assumption that it will cost us $2.25 per share to close this trade. Everybody with me on that? As long as we can get $2.25 or more in the new option, that's the total credit in the new options that we're opening, as long as we get $2.25 or more, our original net credit that we took in is the same. So in this case, if we sold to open the March 77.50 and we bought to open the March 70, we end up a little bit short, right? In this case, we could take in a credit of $2.02 to open, but that leaves us 23 cents shy of a break-even roll of this trade. Does that make sense? Ideally, we want with $2.25. Our best case scenario, without going too far out in time, and even in the process of doing this, we've had to create a bigger spread, right? Even right here, it forced us to create a bigger spread. We went from a $5 spread to a $7.50 spread. We've gone out a month and a half farther in time in the process of doing this. Okay? Now that original credit comes into play. This would not be a good roll unless, let's say originally on a $5 spread, we had taken in $1.35 credit. So we don't have to back up all the way through this process, but now let's say that originally we had taken in $1.35 credit. How does this change the dynamics of the trade now? If all we looked at was this is what we're having to pay to close the trade, and this is really the best we can do opening a new trade without going ridiculously far out in time, without creating a $10 or a $12.50 or a $15 spread, we don't want that big a spread because that's just plain and simply too much risk. But if we can get close, then all we've got to do is take this 23 cents and say, you know what, instead of $1.35 credit right now, I've got to take 23 cents away from that credit, And that means that now I only have a $1.12 credit. Well, that's not as good a situation, but we still have a net credit overall in our account on this trade. And if you take a $1.12, first subtract that from $7.50. We've now created a $7.50 spread. So $7.50 minus $1.12 means our maximum risk is now $6.38. And if you take that $1.12 and you divide that by 638, we still have a possible 17% return, almost an 17, a little over 17.5. So we could round that up and say we still have almost an 18% return. Now that's not nearly as good as the nearly 30% we started with. If we originally took in a $1.35 credit on this trade, if that was originally what we took in, and we've got $5 difference between our strike prices originally, then we take $1.35 and we divide that by 365. Originally, we were in a position to make maybe as much as a 36% return. In fact, that's close enough. We have to round that to 37 because it comes up 36.98. So originally, we could have made a 37% return. But when we have to adjust a trade, what is our number one goal? Once we make the determination that we have to adjust this trade, what is our number one goal? It's to at least break even, right? We may not always get that, but our number one goal is to break even. Well, we've got a situation here where we could possibly still profit in the trade. And it doesn't even have to profit 17%. If we've got that downward trend happening and then we get the bounce off of the next level of support and it starts moving back up, we could set up an order to close that trade as soon as we get back to a break even in the trade. Okay, this is not an easy adjustment to make. It may be fairly easy to understand, but it's not easy in the sense of finding the circumstances that will work. Like I said, there will be a rare occasion where you could make this adjustment and possibly not have to increase your spread and possibly maintain your full credit. Maybe get as much credit for the new one that you're opening as what you're spending to close the old one. You will occasionally find those circumstances. And when that's the case, it is a much easier trade to adjust when you find that. The challenge in this particular adjustment is finding the scenario where you can actually break even on the roll of the options and not have to increase your spread. That's difficult to find. That's why this is, you can do it. It's better than taking a big loss on the trade. A question came in, and I want to read the question to make sure I get it correct. Question came in, let me get back to it. If you adjust, it says if you adjust, it's because you accept you're in a losing position and will try to diminish or subvert the outcome. Yeah, okay, so it was less of a question, more of a comment. Yeah, you're making the adjustment because you're trying to get either a dramatically less of a loss or get into a situation where you could still potentially profit in the trade. But rather than staying in the trade all the way to the expiration of wherever I roll that out to, rather than go into all the way to expiration to try and get that 17%, if I had to make the adjustment to the trade, I am probably at that point in time, I am probably going to get out as soon as I can get out break even. So once I've got this situation where my cost basis has changed, remember we said if we started out at a $1.35 credit and then we lost 23 cents in the roll, we end up at a $1.12 credit. I'm telling you right now, when I can buy to close that whole trade for a $1.12 or less, I'm out. I am getting out when I can buy to close that whole trade for $1.12 or less. Now, let's talk about another possible adjustment, okay? Like I said, that is the least preferable, but that doesn't mean you shouldn't do it. I wouldn't teach that as an adjustment strategy if it wasn't a good adjustment versus just, lumping it up and taking your maximum loss. It's far better than taking your maximum loss. It's just not the most preferred adjustment. All right, another adjustment. We've got our trade, we open it up, we're expecting that stagnant, preferably bearish movement. Stock price reverses into a bearish movement. If we've got a ways to go, if we break the level of support that we set our strike price below, okay, we're saying this is our level of support right here, so we set our original starting strike price below that level of support. If the next level of support is below your long put strike price, we can adjust the trade simply by adding more long puts. Now, if we started out with 10 contracts, we don't have to add 10 more long put contracts. We don't have to add 11 or 12 or 13 more contracts. We could add 3 more contracts. We could add 4 more contracts. The thing we're trying to do, if our next level of support is far enough down here, by adding a protective, we refer to this as a protective long put contract. Now we've got more contracts, more long put contracts making money than the short put contract is losing money. And this is a very simple adjustment to make, but it is most likely just going to lower our loss. It's unlikely that this adjustment would get us into profitable territory. This is it's an easier adjustment to make, but the reality is it's more likely to just narrow our loss. Our first set of long puts will end up covering us on what our max loss would have been on the trade no matter what. Our second set of long puts are there to try and get profit that offsets that loss. It could yield an overall profit in the trade. That is possible. Okay, we could very possibly get into a profitable situation, but on the occasions when I have used this adjustment, my goal with this adjustment is I'm looking at taking a big loss on this. I've got to cut it down. I've got to narrow that loss. I can't see anywhere where I can roll this out to the whole trade out to that's realistic. Already of my long puts trending in the money, but I could add some additional long puts because that next level of support, that the news that's pushing this thing down was pretty significant. That next level of support below that is down there quite a ways, and that's when I might consider adding those long puts. So same scenario, if we saw the same indicators, we opened up that trade, we see things going down, we add those additional long puts. Now the challenge that you get into with this situation is you could trend down like this for a ways, and before the expiration of anything, you could start moving back up, and now you've got more long puts losing money. You got to be careful doing this one. And again, it's more for mitigating the loss than it is for necessarily getting profit. And it's still not the most desirable or not the most favored adjustment to make. In a situation like this, we've got our original trade, and again, we're tracking money in, money out. We're still looking at money in, money out. One of the things I would use to determine whether or not I want to do this adjustment is if the additional long puts that I add to the trade might still keep me in an overall net credit. If my original credit that I took in on the trade was $1.17 and I can add some long puts such that there is still a little bit of credit left overall. In this case, it would be 15 cents. I about put that decimal in the wrong place, so I'll put it right there. If I could do this and still maintain a little bit of credit overall, to me, that's a better scenario than if I spent more than my net credit on that new set of long puts. Now, I might be able to get in this situation by either add fewer long puts or adding them at a low enough strike price. But whatever strike price I add those long puts at, the next level of support has got to be below that so that there's a good chance of them gaining intrinsic value or having some intrinsic value at the close of the market, at the expiration of the options. That's what I meant to say. All right. Again, not the most preferable adjustment, but it is a very easy adjustment to make. Now, I'm going to introduce this adjustment and talk about the most preferable adjustment, but I'm going to put it in this context. If you want to get good at this next adjustment, if you want to learn more about this next adjustment, which is the most favorable, preferable adjustment, you're going to move on through the other credit spreads, and then we're going to teach, if you're going in order, if you're just going in the order of the classes, you're going to move into the other credit spreads, and then you're going to get into collar trades. The most preferable adjustment to a bull put spread that is moving against you is to either preemptively roll your long puts out in time, or wait until stock is put to you at the short put strike price and then roll your long puts out in time and add a short call at the time the stock is put to us and turn this trade into a collar trade. The challenge with this adjustment is the only challenge to this adjustment is that oftentimes when we set up a bull put spread, the number of contracts we're doing to make it worth our time, to make it worthwhile, we oftentimes don't want to do a bull put spread that's got a $1.30 per share return on one contract. If we do that on one contract, we're going to pay $15 to $20 in commission, and we're going to make 130 bucks. And a lot of people look at that and say, don't I have a better use of my money? I'm tying up a lot of my money with that option requirement. Remember in the previous class, we talked a fair amount about the option requirement? We look at this now and say, I'm tying up a lot of money with this option requirement, and I'm only getting $135 out of this. But if you're doing it the right way, if you're being smart about this particular trade, the bull put spread, you're not going to do more contracts than what you could afford to own stock on. Because the safest adjustment, the most preferable adjustment to this trade is either allow the stock to be put to you and then roll your long put out in time and then add the short call, or preemptively roll the long put out in time, wait for the stock to be put to you, and then add the short call. Now, we need to have a conversation here. There needs to be a little discourse here on having that stock put to you and not having your broker immediately exercise your long put and have it sold out from under you, okay? Because you end up in your maximum loss. Here's the situation with this particular adjustment. If you're getting close to the expiration, and I would say is within 2 weeks. Let me back. Let me do this. I'm going to do this a different way. All right. You've got your bull put spread. Let's back up a little bit and get our bull put spread back on the screen here. Okay, here we go. My computer's going a little bit slow on me for some reason. I probably got something running in the background that shouldn't be. Okay, so we've got our bull put spread. You're getting close to expiration, and the short put is either already in the money or it's awfully close to it and it looks like it's going to move in the money. And so you are starting to get concerned, or maybe you're not concerned at all because maybe you've pre-planned the adjustment of moving into a collar trade, but you're looking at everything and you're saying, okay, I could have stock put to me at any time now. When you get to that point, you have to do one of two things. You have to do one of these two things. If you don't do one of these two things, you are looking at potentially taking your maximum loss on this trade, and you don't want to take the maximum loss on this trade. You either have to communicate with your broker and say to your broker, no matter how far down this stock has gone in price, If you put the stock to me, do not under any circumstances exercise my long puts and sell that stock away from me at my maximum loss. If you're doing this trade with a $5 spread, okay, there's our spread, $5, and let's say we took in a $1.35 credit on this trade. What is our maximum risk? $365, right? Because if we bought stock at 80 and we sold stock at 75, we just lost $5 per share. We get to keep the $1.35, so our maximum loss, our complete and total loss on this trade would be a $3.65 loss. The whole reason we adjust trades, the whole reason we set up trades that can be adjusted is because we don't want to take that maximum loss. We want to dramatically lessen the loss, or we want to get out without losing at all if it goes against us. So the worst thing that could happen is the stock gets put to you at 80 and your broker is saying, well, gosh, he opened up a bull put spread. That means that long put is there to protect him from any greater loss than 365. So your broker may, as soon as that stock is put to you, it may be built into the system to automatically sell your stock at $75 to protect you from anything worse than that. And you don't want that to happen. You do not want that to happen. So you get online with your broker. You call your broker, or you use the online chat feature of your broker, or you trade emails with your broker. You go through their customer support, you go through their help desk, and you say, Mr. or Mrs. Broker, I know this stock may get put to me at $80 a share. I've got money in my account to own that stock. Do not, under any circumstances, sell my stock at 75. I don't care if it gets put to me at 80 and it's trading at 62.50. Don't sell it at 75. I don't want to book that loss. And then whatever communication you have with your broker, be absolutely certain you have documented evidence of that communication. I personally love to use the online chat feature, the instant messaging feature, whatever you want to call it, with my broker, because whatever conversation we have in that instant chat automatically gets emailed to me when that conversation is over. So I make it very clear to my broker, don't sell the stock for me. Do not exercise my long put. Whatever you do, don't exercise my long put. Put the stock to me, sell me the shares at $80 a share, and then let me handle it from there. And when my broker has acknowledged that and stated clearly in that instant message that they understand and that they will in fact honor my request to not sell my stock from me at $75 a share, then I've got a recording. So guess what? If I wake up account and stock has been put to me at $80 a share and my broker has sold it at $75 a share and I'm showing a $3.65 per share loss, then I get on the phone with someone and say, I'm going to email you a copy of this conversation and you're going to fix this for me, Mr. Broker. You're going to eat the loss. And they have to do it. If you've got that, if you've got documentation of it, they have no choice. Don't, if you have to have a phone conversation, request that they send you an email or you draft an email that summarizes your conversation and make them respond to that email. Either have them send you an email that documents and you know summarizes that conversation, or you send them an email and make sure you get a response and bug them until that happens. Make that happen. That's one thing you have to do. The other thing, and this is when you get to the point where you believe stock could get put to you. The other thing you can do is when you get to the point where you believe stock could get put to you, rather than waiting for that to happen, you roll your long put out in value, or out in time, excuse me. You roll your long put out, and then when the stock gets put to you, they're not going to automatically exercise that long put. You're going to let the stock get put to you, and once the stock is put to you, then you're going to add the short call, and you're going to turn this into a collar trade. Now, this is something you've, in everything we're talking about right here, all of this has to be taken into consideration. You're still potentially down 365. Okay? When that stock gets put to you at 80, you may still be down 365 in this trade. You're looking for a short call credit to make up as much of this as possible. Plus, you might also, your long put that you started with, it'll be going up in value, but to roll that out 2 or 3 or 4 months in time, it's almost certain that you're going to have to spend a little bit more money to do that. Hopefully not a lot, but you may have to spend a little bit more to do that. So you might be looking for a credit that covers how much you might be drawn down. Remember, this is not a book loss. Here's the big, huge difference. The big, huge difference on this is that being drawn down a few dollars versus booking a $3.65 loss, I hope you understand it's vastly different. I don't get bothered by being drawn down in a position for a short period of time. I get bothered booking losses. Don't book the loss. It's okay to be drawn down. And if you're drawn down 365 plus, let's say to roll this out in time and keep it at the same strike price, let's say that costs us another $1.10. So now we're down 475. We're going to try, if possible, to get 475 credit in that short call. We're probably not going to get it, folks. We're probably not going to get a full 475 in that short call credit unless we want to automatically go clear out to the farthest leap options that we could possibly go to. And our preference is to not do that if we don't have to. Ideally, if we move this out a few months to, say, May or June, ideally we'd like this to be no farther out in time than July or August, maybe September. We don't want to go out to the leap options if we don't have to. And it's okay, it is totally okay if we put the strike price of this right at where the stock was put to us. Because what would be the downside of the stock coming back up and being sold away from us for the same thing we bought it for and us keeping the credit right here? Wouldn't be a horrible thing. And once we're in a collar trade, we're just going to make the same adjustments we would make in any other collar trade. Don't forget, when all this happens, you haven't done anything to worsen your maximum loss. You still kept the credit from your original bull put spread. Okay, don't forget all of that. But if you have the funds available to do it, let the stock be put to you and then roll your long put out. That's if you've communicated with your broker. If you haven't had that communication with your broker yet and you think the stock is going to put to you, you can preemptively roll that long put out. Once the stock is put to you, whether you preemptively rolled your long put or whether the stock was put to you and then you rolled your long put, once you've got that stock, add the short call and move forward in a collar trade. Again, with the idea in mind that as soon as you can get out at a break even or a little bit of profit, you get out. You're not looking at this as having to, you don't have to turn every bull, anytime a bull put goes against you, I'm trying to think of the best way to say this. Anytime a bull put goes against you, you don't automatically have to stay in a collar trade long term. Your best adjustment, your adjustment that gives you the greatest opportunity to break even or get profitable is to take stock ownership and turn it into a collar trade. That's the best adjustment. You can't always afford to do that. You may have decided it's worth the risk to do 10 contracts on this bull put spread, but there's no way in the world I can afford 1,000 shares right now, so I'm going to have to go to one of the other two adjustments. If this one goes against me, I'm going to have to get out with as minimal a loss as I can, or I'm going to have to roll both options out and down, or I'm going to have to add protective long puts. Those are all adjustments you can make. There's nothing wrong with any of those adjustments. They're all adjustments that you can make. But the one that gives you the best chance of getting profitable or breaking even is if you can take that stock ownership, turn it into a collar trade, but then you can still look to get out the very first opportunity when you're back to a break even. Keep track of all the money in, money out, and when you get back to a point where you're break even, get out of the trade. You can be in this trade maybe after you've made the adjustment. It's not out of the question that you could get out of this one for no more, time-wise, no more than a month is possible. I've seen it happen in situations. So those are, now there are other, now a question came in about adjusting it into a butterfly spread, adding a bear put to a bull put and adjusting it into a butterfly spread. That's not a lot different than just adding the protective long puts. The only difference is you're mitigating the cost of those long puts by adding the, you're mitigating the cost of the long puts by adding another short put. Okay, let me go, I'm going to take a moment and go back to that slide. The only difference between just adding a protective long put and adding a bear put, it's essentially the same adjustment with this difference. Let me clean up my marks, okay? You're adding those additional long puts, but to help lower the cost of that a little bit at least, you're adding those, I can't get my pen to work again. Bear with me for a moment here. There's my pen, and now I got to go back to the right screen for you. There we go. So what you're doing is you're adding these long puts, but at the same time, and assume, I've got these in different places so that you can see the different set of long puts, but assume these are all in the same expiration. So now you're also adding some short puts down here. And what that does is gives you more, it gives you some of that downside protection, with the difference being this costs you a little bit, because of the credit you would take in on these short puts, it costs you a little bit less money than just adding the long puts. But if you do it that way, if you and that's just a little variation to it. It's just, to me, it's essentially the same adjustment. It's a slight variation to it. If you do that, you're lessening your chances that a deep drop in the price of that stock could actually get you back to profitability. It'll help you offset the loss, the potential loss, but it's lessening the chances that it would actually go profitable on a deep, deep bearish move. Now, remember I said that this adjustment, when we add the protective long puts or add the additional long puts to the trade, that's more to lessen the loss than to try and get profitable. Not that we wouldn't like it if we could get profitable, but it's more about lessening the loss. Well, that being the case, adding a bear put spread instead of just adding the long puts is not a bad move to make. I don't very often do this because I don't very often make this adjustment. And then one last thing that I want to weave into this conversation a little bit. The last time I did this class live, we didn't talk about this, so I want to bring this into the equation right here. Let's go back to our collar trade adjustment. In a situation, go back here. All right, bear with me for just a moment. All right, now I want to back this one up a little bit. Let me get back to my original bull put spread here. Okay, so we've got our original bull put spread. We had all the conversation about either let the stock get put to you and make sure you have the conversation with your broker so it doesn't get sold out from under you, or you preemptively roll that long put out in time. Now there's one other possibility. When you preemptively roll this long put out in time, there is the possibility that this bearish trend that was causing you to want to make that preemptive move reverses, and before the stock is put to you, or even before you get to the expiration, You're back out of the money right here. If you just stopped right here, what is this trade? What trade do you have at this point in time? Think back a couple of classes to our calendar spreads. If you just stopped right here, do you not have a bull put calendar spread? If in the event you are preemptively rolling a long put out in time with the expectation that stock is going to be put to you, and instead it goes back in the direction you were originally wanted to go, what likely happens to this short put? What is most likely going to happen to that short put? It'll expire worthless, right? How do we adjust a put calendar or a bull put calendar when our short option expires worthless? When that one expires, we add a new one. And if this one happens to expire, we add a new one. We might add it at a higher strike price because we might be back into a bullish move. And if it's a strong bullish move, even though it's a ways out in time, we might go clear out here for the sake of getting a much bigger credit. And then once again, when the stock moves up enough, we exit the trade. Keep track of the money in, money out. When you roll this long put, chances are the one that was right here will have gone up a little bit in value, but you're going farther out in time, so you're going to pay a little bit more for this one. So once you've had several expiring short puts, or maybe a couple of expiring short puts that have offset that, get out of the trade. Exit it. Keep really, really accurate track of your cost basis. That's the key to all of this. Okay, took a little time on that, so we're going to move along to our summary. When a stock in a bull put spread moves below the strike of our short put or moves below our level of support and threatens our short put going in the money, we can roll our long put straight out in time before the stock was put to us. We can add covered calls at a higher strike price, and we can collar the stock until a good exit presents. Now, the order as I went through the class, I went in the order of the least preferable adjustment to the most preferable adjustment. My summary is going in the opposite order. In this summary, this is the most preferred adjustment. Either preemptively roll the stock, or excuse me, either preemptively roll the long put or roll it as soon as the stock is put to us, and then add short calls and go into a collar trade. We can add protective long puts, or you could make these protective long puts a bear put spread. It just adds a little less debit to the trade. And then if you decide to roll both options out and down, the reason I say be very careful about your cost basis is the likelihood is you will increase the spread between your strike prices, and therefore you will increase your risk through the increase of your cost basis. Okay? So keep track of all of this very, very carefully. Keep track of how your cost basis changes. That is a crucial part of any adjustment to any credit spread, especially the bull put spread. And that wraps up our Adjusting the Bull Put class. Thank you, everybody, for some great questions and comments. Bye-bye.